I teach is the mind of an analyst. Basically, the world needs more financial analysts, or let's just call them analysts. And what is the job of an analyst? The reason why financial analysts are so fascinating to me is because ultimately we got to put our money down. So, you can come up with a theory. Let's say I have a friend of mine, he's got theories all the time, and he's like, the government is doing this, and this is happening, and interest rates are this and that, and this is going to, okay, those are all theories. Those are all theories. And they could all warrant research. But in the end, a financial analyst has to do the research and then put money down on the theory. And if your thinking process is poor, you're going to lose money constantly on this. And that's where I think it's the discipline of the money that causes you to think more clearly. Like, you can't just validate, your opinion, or else you're going to get wiped out. So I just want to train more and more people to think in a financial analyst sort of way, in a structured way.
Welcome to the Get Invested podcast, where we share great conversations with experts from all walks of life to uncover their secret know-how and where they invest their time, their skills and their money, and the benefits that this has created. You see, the truth is that everyone invests. Every minute of every day, we're investing our time, our skills, our energy and our money in something. Some of us are investing consciously, some unconsciously, sometimes for good, sometimes for bad, and sometimes for no impact. Get Invested will help you to start living by design, not by default. I'm going to help you to make it happen, not let it happen. You will hear the top tips on how you can live with conscious intent so that you can live more, work less, and leave a living legacy by investing now. Listen to the show to discover the top tips on how to get started, make the most of your investment journey, and ultimately to be living your dream, not someone else's. More episodes can be found on iTunes or at bushymartin.com.au/get invested. Thanks for listening, and now let's get invested.
Hi, Brendan Fodders. Well, what's happening and what's likely to happen with global equities markets? Can you make sense of what's currently going on in stock markets around the world? These are the eternal age-old questions that bug equities investors and will continue to do so. It seems that in our age of too much information, where everyone with a microphone and an audience is suddenly an instant expert, it's becoming much more difficult to separate the wheat from the chaff and to be able to read the tea leaves when it comes to global stock markets. And everywhere you currently look, there are conflicting opinions and scary headlines. The threat of runaway inflation, rapid interest rate rises, bubbles, pending recessions, and stock market crashes abound. But does the hype actually match reality? Well, let's check the pulse by quickly going around the grounds. Of the $117 trillion global equity market cap, nearly 42% is captured in the US, where the S&P 500 is currently down over 13%, and the Dow Jones Industrial Average is down over 9% since reaching a peak on the 31st of December last year. In Europe and the UK, the FTSE 100 index has basically been trading sideways for the last 5 years, with the exception of a 30% correction in early 2020 with the onset of COVID. Meanwhile, the German DAX also experienced a sudden 35% correction immediately after the pandemic hit and has grown and recovered by a staggering 80% till mid-November last year, and since then has dipped by up to 19% in March, with a weak recent rally resulting in a 12% fall since the November 2021 high. In China, the Shanghai Stock Exchange SSE index is down nearly 17% since the middle of December last year. Similarly, the Japanese Nikkei 225 is down roughly 13% since its high in September last year, after growth of 80% since the COVID correction. And locally in good old Australia, the ASX 200 has essentially been trading in a sideways channel since its peak in August last year. So how can you make sense of what's going on, and what should and shouldn't you be doing about it? Are markets going to crash down, race up, or go sideways? And who do you turn to for valuable guidance? For me, it's always been skillful financial analysts who are able to look beyond their egos and inherent biases to predict outcomes that are most likely to occur after considering and curating multitudes of data and evidence alongside people's perceptions. And while anything we talk about today is purely general in nature and can in no way, shape or form be construed as financial or investment advice, one of the best financial analysts and all-around good guys that I know is Andrew Stotz, who shares my vision of transforming your life by getting invested properly. If you've been listening to Get Invested for a while, you remember my great conversation with Andrew back on episode 162. So if you haven't listened to that yet, make sure you do. Because Andrew is very well qualified to identify and help you overcome investment hurdles and to assist you become a successful investor. He's the author of multiple finance and investment books, a recognised finance expert, an angel investor, and a self-professed happy guy. He's also an award-winning financial analyst with more than 2 decades of experience in leading positions in the industry and as a university lecturer of finance. As the founder and current CEO of Stotz Investment Research, or ASIR, his company provides institutional and high net worth investors with ready-to-invest stock portfolios that aim to beat the benchmark through superior stock selection. He's also a sought-after commentator for Bloomberg, US News, The Star, and other regional and global news outlets. And on top of all this, Andrew somehow managed to find the time to host a very popular and highly respected podcast called My Worst Investment Ever, which is where I was humbled to first meet him in one of my most enjoyable conversations. So as a fellow investor, a risk taker, an educator who helps you to create, grow, measure, and protect your wealth, I'm really looking forward to another great chat. So welcome back, and let's get invested again, Andrew.
Well, Bushy, it's great to be back and great to talk with you and your audience again.
Yeah, look,
And for the audience, it was episodes 346 when Bushy shared his worst investment ever. And that's really a lot of the joy that I get in my life is meeting people like you and, getting to hear your story and learning from it. And we titled that one, Focus on Your Health, because it is your wealth.
Yeah, it's spot on, mate. I really enjoyed that chat. It was one of the most memorable chats I've had, and hence why I'm so keen to get you back on to dig a bit deeper. But one of the things I've sort of given you a pretty good rundown and told you what you already know about yourself. But the thing I always like to dig into is why do you do what you do, mate?
I think I want to help people, and it feels great. It feels great when somebody comes. I mean, I have a student of mine he came to me as an intern. He studied at Wabash. He's a Thai man. He didn't study finance, but he said, I want to work in finance. And he came to do an internship with me. And then after that, he joined my valuation masterclass, my online course I have. And then he busted his butt and learned and studied more and all that. And now I just got a call from a company in the U.S. on Wall Street that said, they wanted to get some reference about him. And then basically, I think he should be able to get that job. And when I talked to him about that, the idea that I could help someone like him, achieve the goals that he wanted to achieve, I mean, that's really what I want out of my life. And that's having taught thousands of students over 30 years of teaching, while I've been working in my career, is the real joy of life, because I know I've added value to a lot of people's lives. So that's really what matters to me.
Yeah, look, I've always said that true fulfillment comes from helping others without ever expecting anything in return. And what a great way to do that with, the education that you've helped thousands of people over so many years, mate. But tell me, since we last spoke, and it was a bit over a year ago, what have you been up to?
Well, one thing that's happened that's really happened fast was that the amount of money that I'm advising on, let's say the assets under advisement, has grown to nearly 100 million US from 5 million when we talked, at that time.
Wow, so massive. That's incredible.
It's really ballooned, and I think there's a lot of opportunity to continue to expand that. And I think that's attributed to the fact that I have a very balanced portfolio that I introduce to our client base, and basically also that I started doing monthly discussions with investors and with advisors that I work with here in Thailand. And that really was able to calm people down. I think everybody gets excited, and I always get people on there. Last time I was on, someone said oil fell by 6% yesterday. What are you going to do? And I love to be able to say nothing. Yeah, and here's why. And here's the value I can add, because I know you feel like you've got to do something, but I position the portfolio so that we don't have to do that much.
Love it. Now, this is the question I'd like to throw in, mate, just to keep it interesting. What's something unique or interesting about you that you've never shared publicly before? Yeah,
I was thinking about that. I mean, one of the things that was kind of odd in some ways, but was that I lived in a foster home when I was basically between eighth and ninth grade, the summer between eighth and ninth grade, in going into high school in the U.S. And I lived there because I had basically stabbed my father with a scissors, and we had gotten into a fight, and all because of me and my addiction and what was going on in my life with drugs and alcohol. And I basically did about 2 weeks in what would have been juvenile prison or jail in Akron, Ohio. And that was a real wake-up call where I realized, like, I do not have what it takes to survive in this environment. I got to make sure I'm smart enough not to end up back here. So I didn't go on the straight and narrow. I actually just got more crafty in what I was doing. But eventually I got clean and sober when I was 17. And so to be able to tell someone that you were actually in jail when you were young, in Asia would be almost a death blow, because someone just can't understand about drugs and alcohol and all that. But nowadays, after being in Thailand for 30 years, I think it's not such a big deal to share that.
Yeah, well, I appreciate you being open and vulnerable with that, mate. It's an amazing wake-up call. And if you sort of look back on the accolades and the achievements that you've racked up since then and reflect back on that, it's an amazing journey that you've been on, mate. And, full respect, given that scenario.
That. And the lesson I always share with people is just never, ever give up on your friend or your family. Things can change. And I was pretty hopeless at the time, and it appeared hopeless, but stay positive, stay encouraging, and, be there when they're hurting themselves ultimately, but things can change.
Yeah, it's very wise advice. So I want to sort of shift gears a little bit now and sort of drill into your podcast, My Worst Investment Ever, and get you to share, if you don't mind, some of the top learnings that you've gleaned from how many guests have you had on now?
So I'm now at 540. 40
Incredible.
Just published 541. I just keep on trucking. I interview, let's say, 3 to 5 people a week. I release 3 a week, and I just enjoy it. But I can say that I've got 6 common mistakes that I've pulled out of all of those lessons. And I would say the number one mistake of all, which I really challenge everybody listening to not make, is failed to do their own research. The majority of the troubles that we get into in investing happen because we don't take the time to research it. Something feels right, something feels good, you like what somebody says, and then you jump into it. And so there's no substitute for research. And I think the other part to that I would say is that research doesn't have to be long and complicated. Research can be simple, just searching around, trying to find information, that type of thing. So that is absolutely number one. If I had one piece of advice, I would say just never invest in, and I like to say it this way, Bushy, just to say, never invest in any investment that somebody tells you about.
Yeah, good call. Very good call.
Makes you think, well, wait a minute, where the heck am I supposed to find my investments? Well, my point that I'm trying to make is that do your own research. You're going to get information and ideas from all around, but do your own research to that, and that's going to help you a lot.
Yeah, it's a very good suggestion. Are there any other learnings that you'd like to share with us from the pod?
Well, I'd say, the other thing is people are very poor risk managers. And so the second most important thing is to, properly assess and manage risk. And assess risk means don't go into something slowly if you can. And if something, you say, well, Andrew, I can't go into this slowly because it's a huge, property that I'm going to buy, and it's a huge amount of my wealth, and it's not like I can go in with $10,000 on it. I got to go in or nothing. Well, right there is probably a problem.
Yep.
So you need to assess the risk of a project, but then you have to manage that risk and say, how do I make sure that I don't have an oversized exposure? And I think that's part of what I do in my portfolios is basically help people understand, but why do you have money in bonds right now when, bonds are going down and all that? Yeah, but wait a minute. It's about building a diversified portfolio. And so that's the second biggest lesson and the second biggest mistake is at risk. And then the third one really is about flawed thinking and emotion. So you've got to really, I've recently prepared a lecture. I've given it partially, but I'm going to give it to my students, and I may put it up on my YouTube, which is basically like 14 fallacies, thinking fallacies that I've seen in my life and how to avoid them. And then another one related to, so those are like thinking fallacies, but another ones are behavioral biases. So I'm working on those right now as we speak. And I want to come out with those for my valuation masterclass students also, so that they really make sure, because what I teach is the mind of an analyst. Basically, the world needs more financial analysts, or let's just call them analysts. And what is the job of an analyst? The reason why financial analysts are so fascinating to me is because ultimately we got to put our money down.
Yeah.
So, you can come up with a theory. Let's say I have a friend of mine, he's got theories all the time, and he's like, the government is doing this, and this is happening, and interest rates are this and that, and this is okay, those are all theories. Those are all theories. And they could all warrant research. But in the end, a financial analyst has to do the research and then put money down on the theory. And if your thinking process is poor, you're going to lose money constantly on this. And that's where I think it's the discipline of the money that causes you to think more clearly. Like, you can't just validate, your opinion, or else you're going to get wiped out. So I just want to train more and more people to think in a financial analyst sort of way, in a structured way.
Love it. Love it. I've always said that the biggest battle in any investment is between our ears. It's not out there. It's not anything that's happening out there. It's the 4 inches between one ear and the other, where the success or otherwise will come. So yeah, I love that. So sort of digging into your story a bit again, I'd love it for you to remind us about what you consider to be your worst investment ever, and what you've learned from that.
Yeah, I think that my worst investment ever was I invested in a startup company. And I did it with one of my very good friends. And in the end, he was trying to create some software and a web page and all that was teaching language. He had a whole system of that, and he was a genius in that area. So I really liked his ideas, and I saw what we could do. And so I really liked that, and I put a lot into that. And he put a lot of energy into it. I put a lot of money into it. And in the end, the idea started to morph. It started to change a little bit, and I felt like it should change. So I was behind that change, thinking that this makes sense. And then there just became a time where I remember realizing that he's not going to be able to execute this. And in order to execute it, we would need to raise, I don't know, $3 million, $5 million of money to bring this out to the world market. And when I saw that, all of a sudden I realized, am I ready to go out and raise that 3 to 5 million? Or not? And if the answer is no, then we got to stop. And I basically said, look, we've got to hit some milestones on revenue, and if we don't, I just can't fund this anymore. And I knew it was going to be suicide for myself, particularly because I had put in a lot of money into it. So, and it was all happening when I was working on my PhD in finance. I was flying back and forth to China. I was trying to better myself. I was doing, I was president of CFA, Society of Chartered Financial Analysts, and I was just really a lot of shame that, I was going through all this.
Of course.
And yeah, it's just a lot going on, and I just didn't want to really share it. And I have people that I ask to come on my show, and they go, look, it's just too raw for me, my latest mistake. And I'm like, I know that feeling. So, but that was mine, and what I learned from it, well, I've written some stuff about it, but what I've learned from it is that you want to look for, first of all, is trust. That, do I trust this person? The second, and I did trust him. The second is idea. Is the idea good? Yeah, I thought the idea was pretty good. The third one is execution. And does this person have the ability to execute, or does this management team have the ability to execute? And then the fourth was capital. Is there capital, or am I the only provider of that capital? So now I teach people that, look at investments in startups through that framework if you're an angel investor, and that's a good start. But ultimately, as an angel investor, you should be investing in about 10 different companies. Just investing in one is basically, it's just playing Russian roulette with your money.
Yeah.
And there's syndicates now, and there's ways that you can get exposure as part of a syndicate into a lot of startups. But
Yeah.
most people make that mistake. Again, that's mistake number two, which is failed to properly assess and manage risk when they get into funding one. And I made that mistake myself.
Yeah, the old position sizing and diversification exercise just keeps coming through. Are there any key actions that you'd recommend our listeners take on the strength of the learnings and what you continue to learn around that and investment generally?
I think the first thing is that I'm a framework kind of guy. So I think stop and try to build your framework of what are your longer term goals, and what's right for you. So I would say the first thing is write down what your framework is and where you're going. And, I think looking at things like the habits that get you there and stuff like that, I think we may talk more about that later, but I think that's an important thing, and, the habits of the way you manage things. But ultimately, diversified portfolio is what most people, there's plenty of people that get rich by a very concentrated portfolio.
Yeah.
And they can come and tell you or me that, hey, I got rich from this. So what are you talking about? But we have to remember, first of all, there's always going to be winners and losers because investing has a level of randomness in it. So we know that there's always going to be some winners and losers that may just be there because of luck. And so we wouldn't want to base an investment strategy based upon luck. So then we have to base it on something a little bit beyond luck. And so you have to accept the fact that you're always going to see big winners around you. And you really don't know whether they won by luck or by skill. So build a framework, execute your plan, and ultimately the surefire way of getting rich in the stock market is time.
Yeah.
And I recently wrote something about Warren Buffett's newsletter that he just came out with for the 2021 year. And I did a little video on it on my YouTube, but I was just pulling it apart and I was looking at it. And I was realizing that he started investing in Berkshire Hathaway the year I was born, 1965.
Right.
And so it's 57 years that he's been exposed in the stock market so what is his secret? Number one, he's built a concentrated portfolio of good quality companies. And number two, so we can say two things, right? Good quality companies, concentrated portfolio, and number three, he let that portfolio grow for 57 years. If any one of us did that, and if you go back and you look at his performance, in the 70s, he just knocked it out of the park. In 1976, he had 130% return. In 1979, he had 100% return. And basically, he just did really well in the 70s, and he compounded those gains. If you look at his performance over the last, let's say, 3 or 4 decades, you'll see he's above average for sure, but he's not the Warren Buffett that we all know. But that just shows that even with some mediocre, or let's say above average performance over the last couple of decades, that because of early performance and letting it grow, he managed to amass a tremendous amount of wealth.
Yeah, and his risk profile has changed. He doesn't need to take the risks anymore. And that's the other thing, that we all evolve as investors. And the key word for success in investing for me is sustainability. As you say, that people can be one-hit wonders, and they might do it a couple of times, but how sustainable is that? And they might be winners today, but have that same discussion in 10 years' time, it might be a very different story. So I'm with you on that. What other big mistakes do you see investors and traders making, given your experience across the board, Andrew?
So I think that there's a few. So we really, first thing I see is these people aren't doing enough research. You really got to think about things carefully. Yeah. Second of all is recency bias. We get so caught up in what's happening right in the current time that it's hard to look beyond that.
Yeah.
I would say a third problem that people face is that they believe the Fed. And, if we just take off, if we went into, if we were like from another planet and we came to the U.S. and we talked to people about, let's just talk about iPhone. And we say the mobile phone market is such a free and competitive market. And therefore, we have all these competitors. And we're explaining the power of competition and the power of pricing, that these companies set the prices and the consumers ultimately set the price through what they're willing to buy and sell it for. And basically, we would trust the market to set the price of any product,
Yep.
except the price of money.
Yep.
For some reason, we've been duped to believe that a committee of kind of technocrats can set the price of money. And the price of money, of course, is the interest rate. So a year ago, we heard that inflation was transitory. But if you were a business owner, you knew it wasn't transitory. It was very real. And if you're a consumer, you started to feel the pressure of it. And you knew, okay, yeah, it went up. Food prices went up by 10%. They're not going to go down by 10%.
Yeah.
You know, they're not going to go up. I didn't buy this for 100. Now I buy it for 110. It's going to go back to 100. So we knew it wasn't transitory. And at that time, it became obvious to us, for instance, in the commodity space, that we went overweight in our portfolio of commodities, knowing that this is something that's going to last for a while. And now what? So the Fed got that completely wrong, in my opinion.
Yeah.
And then now we hear from the Fed that it's time to raise interest rates. And so everybody's parroting what the Fed's saying to raise interest rates. And I just go back and think, well, they were wrong before. Well, maybe they're right this time. I would say that any committee that's trying to set a price will occasionally be right and occasionally be wrong. But over the long run, there's no way we would ever, no right-thinking capitalist, no right-thinking free marketer would ever think that a committee of people could set the price of money properly. So everybody's positioned for a rise in interest rates and maybe a substantial rise in interest rates. And I'm not really positioned for that. So I don't believe that that's going to happen. So I would say that's my kind of my opinion now has been over the last, let's say, 3 or 4 months, definitely against consensus, because everybody's talking about is rising interest rates, and particularly the Fed hiking rates pretty substantially by the time we get to the end of the year, that they'll gone from almost 0 to 3%. And I don't think that's going to happen.
Yeah, that's interesting you say that, because I sort of look much more closely at the Australian market, and I've been saying for a while that, and contrary to a lot of other opinion, that I don't think our Reserve Bank, or which is the equivalent of the Fed, is going to jump too quickly, and because they've got time to be patient. There's still a lot of dynamics out there that are really unproven at this point in time. There's signs and there's hints. But the Fed, our RBA, or the Reserve Bank, knows that if they jump too quickly on rates in particular, we could stall and go into recession very quickly. So I'm with you. In the local sphere, I don't see them jumping as quick and as high and as often as what a lot of the other commentators are doing. This is a great segue into. I'd love for you to share your read on. In the context of macroeconomics, where things are likely to be heading with current global equities markets.
Yeah, I would say that the only market right now that I'm kind of, let's say, have some exposure to that's significant is still the U.S.
Yeah.
And I'm a little bit more worried about emerging markets. At this point, I'm not really overweight in emerging markets. I'm not overweight in Europe. So really, and truth is my equity weighting is down.
Yep.
So I have more money in gold and more money in commodities, which you want to be careful as an individual investor. You don't want to go too heavy into gold or too heavy into commodities, because these are not really long-term. These are not where you're going to get rich in the long run.
Yeah, more
commodities
hedge.
have been a very, very bad long-term investment. You might as well buy stocks. They move in the same pattern, so they're highly correlated. Commodities are, but they don't continually rise, and so they would have been an awful investment over 30 years. So the way I look at commodities is it's a chance to play the inflation theme. So if somebody says, I want to play that theme, then you play it, and you may play it for 6 months, you may play it for 2 years, but eventually that commodity theme is going to work itself out, because as Milton Friedman said, the cure for higher prices is higher prices. And we know that when prices are high, it slows down demand. And when demand is slowing down, all of a sudden, that the prices stop rising so much. And so, we're in that situation right now where, so commodities and gold is where I've been in. And then within equities, really, originally I was Europe and US for equities, but I reduced the Europe position a while ago. But the reason why is because generally these are the countries that had the ability to really print their own currencies without a huge amount of impact. But really, it's the US that has the power to print money and push up their stock market and get everything pumped up. And they can do that without major consequences to their currency, only because of the reserve currency. And it won't last forever. But right now, they're able to do it. So that's the reason why I still have some exposure there. But I know also, when I look at emerging markets and stuff, when the U.S. eventually comes down, emerging markets will get hit pretty hard. Usually we're whipsawed most markets are whipsawed. So what I'm looking at from a longer term perspective is that, well, to keep it simple, you can buy an ETF or a fund that owns every stock in the world and then stop worrying about your equity allocation because it will be ultimately kind of set by the momentum in the markets. Yeah. So there's a good fund, for instance, by Vanguard called the VT fund that owns about 8,000 stocks across the world. The U.S. accounts for 60% of that overall fund. And then if somebody says, look, I just need an autopilot because I want to make money, and I think that's a big thing that I try to do is separate. I say, at the end of the podcast, I always say, create, grow, and protect our wealth. And what I say is that we create wealth either through investing in business or we create wealth through our job, where we make $100,000 and let's say we spend $60,000, we've just created a cash flow of $40,000. That is a creation of wealth. Yep. So we want to focus on creating wealth, and then we want to use the stock market to grow that wealth. And of course, some people can create wealth out of real estate, but that's usually because they're doing the business of real estate, let's say. And then some people will create wealth out of real estate just by luck, that they bought the right thing at the right time and they made $500,000 out of it. Fantastic. Yeah. But ultimately, we want to think about a diversified portfolio of stocks, maybe a little bit of bonds, a little bit of commodities, that type of thing, to, a little bit of gold to grow over a long period of time. I can't remember where I started that answer to, and so I'm not exactly sure how I can add more to that, but that's kind of where I'm at right now.
That's given a really good summary, I think. Just touching on a favourite subject of yours and mine, that's risk. What are the risks as you see them in the short term or the medium to longer term, and any emerging opportunities that you're seeing that may come out of what's about to happen over the next couple of years?
So the first risk is World War III. And I believe that if you go back to 2008, when NATO declared that Ukraine and Georgia were going to be in NATO, I believe was the let's say the first battle of World War III. And then when the U.S. actively took a role in getting the government they wanted in Ukraine. Through what has now been clearly revealed through leaked or stolen or spied on discussions between Victoria Nuland and other U.S. State Department people, that basically the U.S. got deeply involved in it. And then the U.S., two U.S. senators, we had John McCain and what's his name from North Carolina or from the South Carolina, I forgot his name, but basically the two of these guys went to Ukraine and told them, to fight against, the eastern regions. And so this was really, and then that was also the time that Putin did his move on, trying to take over Crimea in 2014, soon after what was happening then. So I think that actually World War III was started back then, and Putin's made his big move. And now the question is, how do we de-escalate this? And I'm afraid that President Biden does not have the mental capacity to actually diffuse World War III. And it's a terrifying prospect. And he's run by a bunch of clowns behind the scene that are, and I'll call clowns, when I talk about people behind most presidential, parties and most political parties, they're just crazy people behind the scenes that want to have war. I mean, we've heard one political party in America said Russia, Russia, Russia for, 8 years. They've been itching for this. And so there is a huge risk of World War III. And, We're already seeing the shock waves of that when you look at countries like Egypt, like Kenya, countries, Nigeria, look at Pakistan. These countries are very vulnerable to food shocks that we're seeing. So, of course, just like when U.S. destabilized the Middle East, it wasn't the U.S. that suffered. It was all of a sudden the Middle East was on fire and everybody there was suffering. And then all of a sudden there's this wave of people migrating out of there to try to find a safe place to live. And then all of a sudden that all comes on to Europe, and Europe's dealing with that issue and trying to come to terms with that. And America's great at lighting bombs that end up causing shockwaves and hits everybody else. But America stays pretty insulated. So number one risk, World War III, and that's part of the reason why we've been overweight commodities. Number two risk, the U.S. stock market crashes, and we're seeing a bit of that, right? NASDAQ's down almost 18% year to date, and that's a pretty massive. I think that's the biggest drop that we've seen since the NASDAQ started in the 70s. And then the New York Stock Exchange is down about 7% year to date. That's also a pretty rough start. You got Shanghai and Shenzhen down 18 to 30%. You've got Germany. Germany is going to be in absolute upheaval without energy. That's part of the reason why I'm not going overweight Europe yet from an equity perspective. So I think there's a lot of bombs that are going off right now that we're going to feel the reverberations from. And so I think that is kind of my next thing. And the problem is that, okay, when that happens, the dollar ends up being strong. So most of us think, okay, the U.S. government's spending all this money, they're printing all this money, dollar's got to crash. Well, no, when you destabilize the world, the dollar looks like a safe haven. So the first thing is that anybody betting on a dollar collapse is probably going to be, really hurt from that. The second question, I would say the final risk that I see right now is what's going to happen. I think in the November election, I did a lot of research on this at the end of last year and went out to my client base and talked about it. But basically I said that the Democrats look at risk to be swept in the midterm elections. That's when the U.S. House of Representatives and the Senate will have a portion of its seats that will come up for re-election, but the House of Representatives will all be up for re-election. And I think the Democrats have a tiny 1% majority in the House of Representatives and in the Senate, and they're going to lose that. It could switch almost where Republicans end up with 5 to 10% majority in both the House and the Senate. And I've become more sure that this is going to happen. So that means that when the stock market starts to crash, what's the Democrats going to do? Biden's going to have to get Powell to bail out the markets. And so part of the reason why I'm a little bit hesitant to say that the U.S. market is going to crash this year is because I think from a political perspective, they're going to see interest rates aren't going to work. The markets are going to crash. They've got to save the markets. And nobody wants pain these days. Everybody wants to be rescued. And so I think that they're probably going to try to rescue the market. So that's part of the reason why I think we're not in a situation where the Fed's going to increase rates. They're never going to get to where people think they're going to get.
Yeah, no, that's a really good context. So, given all of that, how do you feel that investors can continue to make better decisions in these times of continuous and radical uncertainty and the exponential change that continues to happen across the globe?
So, let's just talk about a person with very limited time and experience. But let's say they're young, they're 30 years old, maybe they're young, like 40 years old, but, they're reasonably young. For those people, looking at a fund that owns every stock in the world and then contributing to it on a regular basis, basically, I did some study a long time ago. I didn't publish it, but I looked at it internally to try to think about something. And basically what I was doing is saying, okay, the stock market goes up and down over time. And if you did dollar cost averaging, you'd be putting in kind of an equal amount. And then as you make more money, you'll put in a little bit more and it'll be equal amount. So I did this kind of test. And then I said, okay, so while the market's going up and down during these times, and I put some money in at the peak and I put some money at the bottom in this year or in these couple of years, what's the difference in return that I'm going to get over a 20, 30-year period? And I found that it's very tiny.
Right.
Very tiny. But let's just say, if you could put more money in at the bottom of the little cycle that you're going through now, that's going to be part of a longer term investment horizon, you're going to make a little bit more, maybe by 0.5%, maybe even 1%. But the problem is you got to time that right. that study basically says, that you timed it right, and nobody's going to be able to time it right.
No.
So what I can say is that from a dollar cost averaging perspective, just keep putting money in and don't think about the time too much about whether the market's high or the market's low.
Yeah.
Pick a highly diversified fund that owns every stock in the world and consistently contribute to it, and then you'll be fine over 20, 30 years. So that's my first piece of advice that I would say for the absolute beginner. You can start that and implement that now and, go with it.
Yep.
For the next level of people that want to kind of play around a little bit more and all that, bring in 5% bonds, bring in 5% gold, bring in 5% commodities. You can play a little bit. But the point is that you don't need those things. The objective, really, there's only one asset class that matters, and that is stocks.
Yeah.
Bonds, gold, commodities, all of these things, all of what we would consider to be other asset classes, art, all this stuff. These asset classes are fine, they're unique in some way. But the way I like to explain it, Bushy, is that I own 40% of my business called Coffee Works, and my best friend Dale runs it. He's a CEO, and he's been the CEO for 28 years.
Yeah.
He's got a team. He's got employees of about 100, and he's got a management team of about 10 people. And those 10 people are busting their butts right now to try to figure out how to maintain the profit margin when the cost of raw material, green coffee, is rising.
Yep.
How do we adjust our prices without damaging our customers? How do we get more efficiency out of our business? And they're going through this process, and then they're maintaining the margin as best that they can. Now, imagine if you own 8,000 companies in the world through a fund like that Vanguard fund. You now have 8,000 CEOs working for you and 8,000 management teams working for you, all trying to figure out. Now, some of them aren't going to figure it out very well, but some are. And ultimately, I just want to sit back and enjoy the power of that group of people working their butts off. And gold doesn't have that. And bonds don't have that. You don't get the upside of that with bonds.
Yep.
And when you think about commodities, doesn't have that. Property doesn't have that. Art doesn't have that. So ultimately, there is one major asset class that you've got to make sure you're exposed to. So that's just my way of thinking about it.
Yeah, it's a great way of thinking about it. And again, it builds in the diversification. You've got effectively a very large team of people working for you, essentially, rather than trying to pick winners in a race, in a horse race, which is the other alternative, the individual stock picking, which people, I believe, still get caught up in. And that's all right for a bit of fun. But if you're looking at true sustainable growth over the long term, then the approach you've just suggested is a very good one. And people try to find excitement and try and make investment into a lot more than it is. But my own belief is that really good investment is extremely boring, and so it should be.
Yeah.
So, no, interesting. Any final thoughts then on how best to survive and thrive in the interesting times that we continue to live in?
Well, I mean, one thing you can say is diversification does, help. Truthfully, you don't really want asset class diversification, Bushy.
Yes.
This is something that people don't think about. You just want to be exposed to equity over 20 or 30 or 40 years. If you can do that, those management teams are going to make something out of it, right?
Yeah.
The only reason why you want to have diversification across asset classes is if you can't bear a massive fall in the value of your portfolio. So to give you an example, my mother, as we've talked about before, is 84 years old.
Yeah.
And she's not going to live for the next upcycle that could happen over the next 10 or 20 years.
Yep.
So if her value of her portfolio, if her portfolio was only in equity and it collapsed by, let's say, 50, 60%, all of a sudden what she has to live on, and she's going to be pulling out money, of course, also to live on that, it can really damage that portfolio fast. And so that's the reason why she has a lot of bonds in her portfolio. And bonds are really the ultimate. Basically, there's almost no correlation, or there's even a negative correlation between stocks and bonds over the long term.
Yeah.
And you could say that gold has basically no correlation with the markets. So, it's not a bad diversifier. So that's the first thing. And then the second thing is if you're so behaviorally biased and you're so twisted in your thoughts that a large fall in the market is going to throw you off, then you could argue that, well, okay, maybe it makes sense to diversify a bit so that you don't go through that. And that's a little bit about what we do in my portfolios that I do for investors, because, they can't bear that. And just to give you an example, let's just look at Warren Buffett for a second. And first, let's look at the S&P 500. Let's look at the worst year for the S&P 500.
Yep.
The worst year for the S&P 500 was 2008. And the S&P 500 went down by 37% in that year. That's a heavy fall.
It's big.
But that's nothing compared to if you were just owning a small group of stocks. Now, Buffett was good at picking stocks, but when his worst year was 1974, and his portfolio fell by about 50%.
Yeah.
So now that's a great stock picker. You can expect that if you are a good stock picker, your portfolio could fall in your worst year by 50, maybe even 60%.
Yeah.
And so if you can stomach that, owning a small portfolio of 10 to 20 stocks is not a bad option, but most people don't have the skills, the time, the knowledge, the interest to manage that. That is a full-time job of what fund managers are doing all around the world, including myself.
Or have the mental fortitude to actually see through those downtimes. That's the other big challenge with that, is that when the crash happens, having the stilly resilience to stick through it is a big challenge as well. So
and that's a lesson that I've learned over the years, and the way I handle that for myself and for my clients is basically I only consider rebalancing my portfolio every 3 months.
Yeah.
I have a date set a year in advance. I know for every 3 months the dates that I'm going to work, and I'll work on the portfolio for about 2 weeks with my team. We'll do a tremendous amount of research, and then we'll come up with our conclusions. And once we come up with our conclusions, we'll make some adjustments, and then we won't touch it for 3 months. And that framework, coming up with that kind of systematic way of doing it helps you overcome. And then the other thing is, though I'm on top of markets and I know what's going on, the truth is I don't have price charts on my computer, and I never ever look at the market on my computer. I look at the market at the time that I am rebalancing, and at other times I'm focused on other things.
Yeah, love it. No, that's very, very sound and ephemeral advice there, Andrew. Mate, I want to switch now into the good old bushfire lightning round to sort of re-dig into some of those key questions that I peppered you with last time, because the audience loves to glean your words of wisdom on that. So what's your current favourite quote and why?
I just love the quote, "Good, better, best, never stop to rest until your good is better and your better is the best." And I always attribute that to my mother, but when I ask her, she said, "I don't think I said that," but who knows? But I love that quote, and it inspires me to continually improve.
So it's a cracker, and it's rolls off the tongue. You've got that. You've said that a few times, mate, because that just rolled off the tongue beautifully. But it's switching back to the old literary front. Then, what's the current top book that you'd recommend we have a read of, and why?
So I got it with me right here. It's called Atomic Habits. It's one of the most popular books of all time. And it's the first book I've covered in my book club that I do, where we meet once a week and talk about one book per month. I just think it's a great book to help us remind ourselves that we set goals. Goals are our destination, and habits are how we get there. If you want to lose weight, you got to figure out, what are the habits I got to put in my life? If I want to build wealth, whatever that goal is. So, and I was telling you earlier that I created a video on it on my YouTube, and I have a cheat sheet there that you can download. So if you can't bear the video, at least download the cheat sheet, and you'll have a one-page document of everything that's taught in this book, and it's a valuable book.
I love it. Yeah, I sort of did a section on the book in one of the intros to one of the previous episodes on Get Invested for that very same reason. And that's another beautiful little segue into my next question, because I want to ask you, what's a current personal happy habit or a rewarding ritual or a daily discipline that you believe contributes most to your investment success?
I would say that for me, early morning rising, number one.
Yeah.
That is the thing that helps me get focused on getting done what I've got to get done. My workload is really heavy. The
Yeah.
second thing, and this is something new, I mean, it's not easy to find new things because I've read every book on it and I've done everything, is when I write down my top 3 things I want to get done that day, I read a book and it talked about writing down the number of hours or the amount of time that you're going to think it's going to take to do that thing. And so I've started bringing that into my daily planning.
Yeah.
And that's been really eye-opening. I've kind of I'm writing, oh, that's just going to take a half an hour. And I know, no, that's going to be 3 hours. And it helps put things into perspective. And so I'm very good at managing my time, but this is something new that I've just taken on board.
Yeah. Yeah, go on.
I was just gonna say, there's one other thing that I've done is I've done it about a year or so ago, which is I set days for certain things. So Thursdays are podcast and interview days. Mondays are my research days. Wednesdays are my research days. Tuesdays I'm talking to my clients, and Fridays I'm writing my emails and doing the final things for the week. But the point is that it's really exciting when you break up your week like that, because then you can kind of say, okay, I'll do that tomorrow because tomorrow is a day that I'm going to, and I've found that that's maybe more productive because you're batching stuff into one day.
We're obviously peas in the same pot, Andrew. And most of mine's thanks to my awesome wife, Sonia, who just automates, systemizes, and puts a process and a framework in for everything. And just like you, I have days of the week where I'm doing certain things. And also like you, again, thanks to my good wife, Sonia, I live and die out of my diary. So my diary becomes my task list, and I'm always actually, I'll populate it with what I think the time's going to be, and color code it too, so that I can see from a meaningful perspective, an admin perspective, and an internal perspective how things are looking. But then I'm always upgrading it to say, well, this is how long I thought it was going to take. This is how long it actually took, and therefore my future planning becomes better and better as I work through that. So it's a great way to combine effectively a task list and your diary and manage your time all from one source, mate. I love that. So, mate, just to bring things to a conclusion, then can you sort of summarise your key takeaways for our audience of investors today?
Yeah, I mean, I think the first thing is that equity is the number one asset class that will help you build wealth. So that's the first thing.
Yeah.
The second thing I would say is remember to separate the creation of wealth from the growing of wealth.
Yeah.
Use the stock market to grow wealth. Create wealth through your business or through the gap between your salary and your monthly costs. And then the final thing I would say is that we've learned it from Buffett, stay invested as long as you can. He did it 57 years so far. If you could do 30, 40, 50 years of consistent investing, you're going to be fine in your retirement. So those are some of the things I guess I would leave it with.
Yeah, I love it, mate. What's next for you then, Andrew?
Well, I'm definitely growing my asset management business, and I'm enjoying that a lot. So I see a huge potential there, and so I've got some deals I'm working on that should expand that. If I can get to, I want to get to 300 million US by the end of this year.
Wow!
But ultimately, I think we can get up to about a half a billion US in assets under management. I have a new fund idea that I'm thinking about, what I'll call the 100-year fund, where I'm going to try to buy stocks like Buffett did, with a little bit more diversification, but still build a portfolio of about 20 of the best companies I can find in the world.
Yep.
And then try to hold those, only rebalancing on a 6-month to an annual basis, and set it up as a fund and a structure that will live beyond me. And the process for how we select those stocks and how we manage the risk when one starts to go down is all documented and it's executed through my research team. And that way, what I'm trying to do is get investors to be able to access what Buffett had. Now, we're never going to be a great stock picker as Buffett. Buffett's return on average over 57 years was 20%. The stock market was up 10%. So he did 2 times the stock market. But if we could just get 13% instead of the stock market 10%, and we could compound that over 50, 60, 70 years, from a generational perspective, we would really be building our wealth. So that is a project I'm working on with the local fund management company here, but I see the opportunity to bring that around the world.
Yeah, I love it. Very exciting, mate. So, given all of that work, and I don't know where you find time to sleep, mate, but how can listeners find out more or get involved with you? How do they do that?
Well, the best place to go is my worstinvestmentever.com. I'm always there, and you can reach me through the About section and contact me. The other way is to go to LinkedIn. I'm also on LinkedIn all the time at Andrew Stotz, and just reach out, and I'm happy to talk.
Mate, always love talking to you, mate. Everything that you say is worth listening to, unlike a lot of other players in the space. So I really want to thank you for being so generous on coming back on Get Invested today, and look forward to having similar conversations in the future.
I enjoy it very much, and it's great to talk to you and your audience.
Thanks, mate.
Yeah.
We'll keep in touch. Talk soon.
To get a summary of all this investment gold in the show notes, just email me on hello@khgroup.com.au. That's HELLO@khgroup.com.au. Or check us out at www.bushymartin.com.au/Get Invested. I look forward to joining you next week for another episode of the Get Invested podcast. So thanks for listening, and as always, dream as if you'll live forever and live as if you'll die